Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. The broader macroeconomic shifts combined with reactive changes at central banks add sufficient background noise to any discussion on investments. On this episode of the Seismic Shifts in Corporate Treasury Series, Jeffery sits down with Managing Director Fred McMullen and Executive Director Rick Wilkinson of Morgan Stanley to discuss major shifts impacting investments today. Listen in to find out more.
Welcome to the Treasury Update podcast. This is Jeffery. For this episode of the Seismic Shifts series, we turn to two experts from Morgan Stanley. First, Fred McMullen. Fred is a managing director and the co-head for Morgan Stanley's global liquidity business. Previously, Fred was the lead relationship manager for liquidity and fixed income clients in the Northeast region. He joined Morgan Stanley in 2010 and has 28 years of industry experience. Before joining the firm, Fred was VP in Goldman Sachs Asset Management Bank, Wealth Management Channel, and a vice president on the sales team at Fidelity Investments Retired Services. Fred received a BBA in finance from the George Washington University and an MBA in finance from the University of Notre Dame. He holds the Chartered Financial Analyst designation. Welcome to the podcast, Fred.
Thanks, Craig. Good afternoon.
Also joining Fred is Rick Wilkinson. Rick is an executive director and the head of platform development for the global liquidity business. He joined Morgan Stanley in 2006 and has 12 years of investment industry experience. Rick received a BSBA in finance and accounting from the University of Richmond. Welcome, Rick.
Thanks, Craig. Thanks for having us today.
So we'll begin by looking at some of the blurring of categories. In some of our discussions that we've had, gentlemen, we see the consolidation and convergence increasingly evident. And I'll just point out a couple ways and then ask you some questions about that. So first, there tends to be a consolidation of tech providers, and this is happening both in the portal space, treasury management systems, with banks and investment managers. This is also creating a convergence or a combination of services across these same domains. So I guess I'll start with you, Rick, on this section. Is what's happening here with regard to consolidation and convergence?
We're seeing a lot happening in this space. I think it might make sense to take a step back and look at how these different layers of the Treasury technology ecosystem have been segregated. Let's look at the portal landscape first. That was one of the first technologies that was introduced that really helped the corporate treasurer in their day-to-day activities. It allowed them to go to one spot to place all of their investments instead of having to go to each of the fund families independently. Now, traditionally, portals were run by banks or independent technology companies and weren't really run by asset managers. Now, you also have portals over time, their functionality has greatly enhanced. There's a lot of analytics that are available in portals today, and other enhancements have come down the line. You also look at the different account structures that the corporate treasurers could choose when they're looking at a portal. Before the financial crisis, a lot of corporate treasurers like to use portals that were an omnibus nature, where they weren't facing off directly with the fund companies. The financial crisis changed some of their behavior, where they wanted to change and invest directly, so they had direct exposure to the fund companies instead of having to go through the portal provider to access their money. Now, as we move further away from the financial crisis, you're seeing a change back to omnibus. So there's a lot of different options out there. Now, if you take a quick look at TMS systems, the TMS space has also evolved over the last several years. Originally, TMS systems, you were using an installed system that wasn't very customizable and they were expensive. Over time, they've evolved into the SaaS model, makes it a little more customizable, a little cheaper, even though a lot of them still come with a hefty price tag. This price tag and ease of use not really being there, you see a lot of the middle market type companies still using Excel to manage their day-to-day responsibilities. Now, if you talk about investment managers real quick, they traditionally focused on managing cash and distributing products to the end client. Typically, they did not provide technology solutions to clients. Now, these different layers of the Treasury technology ecosystem, there was some connectivity through file-based integrations, but this wasn't really scalable or efficient, even though it did allow information to be passed back to one system where then client could access it. What we're seeing today is now a consolidation of these different layers of the ecosystem into one spot. So first, you see investment managers have started to aggressively enter the portal space, either building in-house technology to offer portals or by acquiring technology companies or portal companies. You also look at the TMS providers, and they're starting to offer functionality, investment functionality, by partnering with portal providers. We've seen several deals over the last year or two where money market fund portals and TMS providers are now working together to deliver investment functionality directly within the TMS itself. And then there are other portal providers out there that are starting to develop TMS-like functionality within their portal to enhance their offering.
Why do you see this happening? Why do you think this is happening? Is this just the natural development of people trying to move up or downstream in some type of vertical integration? Is it a defensive posture? Is it related to the drive to efficiency or something else?
I think there's several things that you can look at here. One, it's competition. There are more and more portals out there, right? Originally, investment managers weren't really in this space, but now they're entering the space. So the competition to drive assets to portals is increasing. Also, everyone in the industry is realizing that corporate treasurers are continuously asked to do more with less. So the technology providers and asset managers are trying to gain market share by providing solutions that will make the corporate treasurer's job easier. As younger professionals are entering the workspace, they're used to utilizing technology in their day-to-day life. They're going to expect to utilize similar technology in their jobs. They're going to want to go to one spot to be able to do everything that they need to do to execute on their function. And from the asset manager side, as fee pressure continues to increase, investment managers are looking for new ways to reduce expenses and attract new AUM and increase revenue. As you bring those things together, you're seeing this enhancement in the space, the convergence of the technologies coming together, and it's ultimately going to benefit the end client. Now, a lot of this is in its infancy, and there are going to be some growing pains in some of these technologies that are being offered, but over time, over the next few years, expect to see more in this space, more development, more enhancement, and more efficiency for the end client.
Yeah, it's interesting as you talked about those. Let me see if I can just recap what I heard. Why this is happening is there's a couple external pressures. One, the pressure for efficiency and straight-through processing is driven largely by treasury groups with limited staff. They want to do more with less. They're expecting more. The second is the asset managers moving into the portal space, and I don't know if you referred to it as a rush, but there's a bit of a rush to own more of the landscape there. So there's an element of gathering assets that way by also offering technology and owning a couple pieces of the ecosystem. Finally, this drive, the investment arena, has been increasingly competitive over time, reducing the number of basis points you can charge. And so there's been this multi-year, or at least a decade-long pressure to reduce the expense ratio. So reducing expenses is a key element of why asset managers would move into that space. Is that the key things?
I think you hit that right on the head, Craig.
Yeah, that's interesting. So some different drivers are all moving to the same vertical integration, either by a single company or by these combinations and consolidations. So that's quite interesting. What else do you see happening over time? Is this going to cause some of these portals to disappear, more acquisitions into families? You want to weigh in on what your expectations are, or should we leave that alone?
I think that you will continue to see developments, especially from the asset manager side, where asset managers are continually going to try to increase their presence in the space. I think you're going to see the independent portals, the larger independent portals react like they have so far and continue to try to keep their market share they've traditionally had. You also have the banks, which we haven't really touched on yet. The banks that offer portals, they're going to keep their market share for a large part because a lot of the clients using a bank portal are using it for a certain reason. It's going to be hard to take those clients away from the banks. You might see some consolidation, but you're definitely going to see competition continue to increase in the space over the next several years.
Yeah, that sounds reasonable. This ongoing pressure to compete. So definitely the blurring of categories happening here. And I wonder if this would have happened as quickly, just purely on the technology front, if there wasn't so much pressure on the the earnings from fund managers, for example, and that concept that these portals have grown enough that they're making an impact, and there's enough to be of interest to other players like treasury management systems, fund managers. Just thinking back historically, I know these portals, some have been around somewhere around 20 years. The financial crisis was about a decade ago. So what are some of the major shifts that have either made portals more attractive, less attractive, responsive to different elements? Give us a quick summary of what's happened in the intervening 20 years as additional context for your comments.
Sure. So as we mentioned earlier, there were some shifts in the types of portals that clients wanted to use, whether around the financial crisis, it being from Omni to direct, and now as we move away from the financial crisis back to Omni because of the increased efficiency that an omnibus portal offers over the direct-to-fund portal. But what I think the portal companies have done well over time is respond to market events and respond to client demand. So if you look at what happened around the financial crisis, clients were demanding to see what the underlying funds were holding. Right? So the portals introduced new functionality to track the underlying holdings, to aggregate exposure across an entire portfolio to see where the client's exposure was. Then as you move into money fund reform a few years ago, clients were interested in tracking the metrics that could possibly trigger a fear gate scenario. So the portal started tracking weighted average maturities, daily weekly liquidity percentages, net inflows and outflows of a fund. A lot of the functionality that's been delivered by these portals have been in response to market events.
But thanks for that information on this blurring of categories from different types of providers of services or asset management, from banks, investment managers, treasury systems, and portals. Now let's shift gears to the other component, and perhaps I'll focus more on you, Fred, in terms of AI, artificial intelligence with investments. We talk about this concept of the emergence of AI in investments. Where is it in the stage of adoption, planning? But before we do that, Fred, maybe you could start with your definition or description of AI, maybe generally, and then maybe provide an example in investments. What are we looking at here?
Sure, happy to. So there's no single definition. It generally refers to the ability of machines to exhibit human-like intelligence and some degree of autonomous learning. The idea here is that it can really help companies, whether they're industrial companies or financial services companies, banks, you name it, change their operating models to deliver enhanced value. In a recent white paper published by Deloitte, they highlight, I think very succinctly and effectively, how that value is created. And it's by the ability to recognize patterns, anticipate future events, create better rules, communicate with other people, and make better decisions. And so that comes with that a big concern. The concern is, is this more about augmenting the intelligence of the workforce, or is this about replacing? And there's going to be some displacement, of course, but I think this is much more about augmenting. You could see just numerous examples of this, across, again, industrial and financial businesses.
Yeah, Fred, I like your comment about augmenting or replacing, and there's probably some of both. I think that's the case, but that idea of it's a very powerful tool and augments what people can do and leverages different capabilities seems like that's one of the big areas of promise for AI or machine learning as a subset of AI. But what's going on now? What's real, and what's maybe a little bit farther off that we should be thinking of in the next year, 2 years?
Sure. And we have I think what's interesting as a large global financial services company and investment manager, we have the benefit of interfacing with all types of companies and institutions around the world. And we interact with them in many different capacities, but we have a large research team that has a great 360 view because they're looking at the companies that are developing this technology and where are they in the development of that technology and how that's transforming these companies and creating these new dynamic growth opportunities in the economy and the investment markets, but also how are the companies that are trying to take advantage of this technology, how is that impacting their business, transforming their business, how effective are they in making the capital spends in ways that impact their business. And in terms of how it's real, I mean, you hear terms now, not to focus on manufacturing too much, but a second machine age and a fourth industrial revolution. So it's here in manufacturing. I mean, in the next decade, the majority of industrial facilities will employ some type of AI. In industries like financial services, my industry, and in functions like Treasury, I think the real focus is on data. And data harnessing technologies are changing how organizations obviously collect, analyze, and act on information. And that's very real, and we see that in our businesses across the board. We're focused on technologies that can be applied to risk management. How do we lend money? How do we make better credit decisions in our lending decisions to individuals as well as institutions, companies? How are portfolio management, trading, clearing, customer service? I mean, it goes across a whole host of areas in our business. Specific to investment management, you're trying to improve the risk-return profile of your investments, create alpha, minimize credit risk. In the liquidity space, obviously, we're trying to protect principal. Are we using AI to optimize liquidity? Making sure there's enough liquidity in the portfolios to meet clients' needs, but not having too much so it's a drag on the return of the portfolio. That's where things like AI are coming more and more into play. In the Treasury, it's the timing of debt issuance and FX transactions. AI is going to influence that over time. Things like stock buybacks. How do you time stock buybacks? What are the size of buybacks? So there's so many ways that this is impacting financial services and tangentially the treasury management groups that we service.
Interesting. I hadn't expected that you were going to mention the stock buybacks in terms of timing and size, but I think that makes sense. And then on the liquidity management side, it sounded like you were talking about the ability to use the machines to support better forecasting that's more accurate for the operational flows of an organization, for the investment portfolio. Very, very interesting.
Yeah, for sure. Certainly.
I guess when we think about this early impact in financial services and treasury, to what extent is this a sandbox of learning to gain experience to do heavier lifting, more lifting with AI? And what percentage of it is it's already making significant transformations? Where are we in that mix of learning versus transforming the ecosystem?
It's a really interesting question, and our view is that it's really a strong mix of the two. It's really both, because in terms of the here and now and what's being transformed, I mean, you look at investment management, you look at trading being done algorithmically and how much trading is done algorithmically these days and how that's impacting volatility in the financial markets. You look at in wealth management, robo-advisors and how they're gaining a much larger share of the market. And there's even the potential for this whole robo-advisory model to permeate corporate treasury. There are people who have developed what they call treasury robo-advisors for institutional treasury departments, and I think it goes back to what Rick talked about. When you have more of that convergence, I think there's more of an opportunity for that to take over. But it's still a giant sandbox, because in terms of the research process, whether it's credit research or researching stocks and the data collection and the pattern identification within that is still, it's very robust. There's been quantitatively managed portfolios for quite some time and modeling, et cetera, but that is still, there's still an incredible amount of resources being focused there, and development. Issues like, blockchain and how we store and transmit data and what that does to the back offices and the operational processes of our businesses, and also what the impact it has on the transmission of money around the world. Right now you see what's happening in the payment side of the world. When you want to pay something or move money, how instantaneous you can do that. On the institutional side, through the SWIFT system, the FedWire system, you cannot move money instantaneously 24 hours a day around the globe. I wouldn't say it's a clunky process, but it is not an instantaneous, seamless process. But that is going to change over time with these technological developments. So I think it's really both. I think in manufacturing it's at a tipping point. I don't think it's at a tipping point in terms of financial services and in terms of service groups like treasury management functions.
Yeah, interesting. I know that in some other areas of financial services, like auditing, it's reaching the tipping point, or at least most of the auditing firms see it in that space. But like you said, it's a little earlier in the financial services arena. Some excellent points. Now I wanted to get back with both of you, do a little synthesis of pulling the two things that we're talking about together, or maybe focus on analysis. What are you telling your clients? I guess in the areas of, there's a blurring of categories, there's a growth of AI across all industries, but also in financial services. What are you telling your clients? How should they think about that? What should they be thinking about? What should they be doing? What should they be monitoring?
Yeah, it's really interesting, because as we travel around the country and we talk about some of these themes and trends, in some of the groups it's a very mixed bag, because in some of the groups we deal with, they are incorporating advanced treasury technology in installing treasury work systems and trying to achieve that automation and efficiency that we all want to achieve. And then there's a lot of folks we deal with that are very concerned about that, and we talk about some of the benefits and how that changes some of the workflow. For example, you could even bring it down to cash forecasting, and you could talk about a treasury tool that allows for very real-time automated cash forecasting, and you'll have someone ask, well, why would I ever want that? Because that's what I do. So there's a fear factor. It's overcoming that's what I do. So I think you've got to start very fundamentally by convincing people that the benefits of freeing up time and resources to work on more value-added initiatives. What can you do if you have better cash flow forecasting? What can you free your time up to do? Are there other areas of the business you can automate or make more efficient? And I think it's that mindset that has to happen. I think also we tell people to start with the basics, because what we find is this topic of portals in some ways is a little bit played out. It's a trend that has been in the making for 20 plus years, and most of the clients we deal with transact using a portal in some way, shape, or form. They don't necessarily have their arms. Their main function is not investments. It's not understanding portals. Their main function is managing treasury. And they don't understand necessarily all the optionality of different types of portals and the different functionality and the potential to integrate that functionality. So we want to start, it's really starting with the basics in many ways. And I think one of the key things is people need to understand the economic implications and the trade-offs when they look at these issues, because oftentimes we have a client, they'll just look at a portal and say, okay, this is just a way to make my money market fund or trading of other liquidity vehicles much more efficient and simple, save some time, that's great, but there are real economic implications these days, because it may involve, you're sending economics every time you place a trade in a liquidity vehicle, you're sending economics somewhere. What are the economics to the portal? What are the economics to the underlying investment managers or banks? Are there tech credits involved? Tech credits is becoming a hot topic, and many clients are not aware of tech credits and how that could potentially influence or help them abate the cost of the technology that they're paying for.
There's this idea of starting simple, understanding there's start with the basics, understand that there are economics and trade-offs. I think there's also sometimes some distractions or noise that can distract people. How do you help advise your clients on staying focused and determining what's worthy of their attention and what needs to be, moved off to something less important or ignored?
Yeah, that's a good question, Craig. And I think some of it goes back to what I talked about a little bit earlier. With some of the advancements in the space are new, and they're not fully played out yet, fully tested. So there definitely is some noise. So I think it's important when we talk to clients, like Fred was saying, we educate them on what's out there, but also be upfront with them about the technology and how it's evolving. And if you want to get in at the forefront, some of this technology might not be as seamless as it will be in a couple years. So do you want to invest in that right away, or do you want to see how it plays out? But I think it's very important for clients to talk with their investment managers, talk to their portal providers, and ask them what they're doing, what they're seeing in the space, what technology they're utilizing, and what's coming down the pipe. And then also talk to their peers to find out what they're using. Have they implemented some of this, and has it been successful for them? I think that's very important.
Very good. Thanks for all your input, Fred and Rick. This has been very interesting and useful. So thanks for joining us on this Seismic Shifts, a focus on investments. Appreciate your time.
Thank you, Craig. Really enjoyed it.
Thanks, Craig.
Thanks, everybody.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.